Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 334. And today we'll talk about what to expect from this budget in terms of capital gains. So, this is a subject that is always in fashion ahead of the budget. So, we'll take a look at the history of the capital gains itself. But first, like recent times, an introduction to the Wild program. So, weekend investing loyalty discount program for our subscribers. If you've completed 1 year, 2 years, or 3 years with any strategy, these discounts are applicable to you. Please use them to do your current renewals and also to use the same offer to subscribe to any other weekend investing strategies. These are this is one of its kind program to be started by weekend investing. Nobody else at Smallcase, in terms of hundreds of managers there, is offering this special program for its users. So please make use of it. The discounts are already applied to your account, so when you go and renew, it will just automatically apply there. Uh, Look at the Nifty. This is a daily chart on the Nifty. You can see that we started this struggle somewhere in September, October 21, from 18,400 odd levels, went down to about 15,200 by uh, end of June 2022, recovered from there 15,300 to 18,800 by November, December 22, then a correction to 17,800, and now right now we are in slight limbo as to where to go. Now this trend line, matching the tops of these three or four peaks, was tested, retested. A bounce has happened exactly from there, 17,800. So this remains very, very significantly important. A break below 17,800 or 17,700 will certainly be catastrophic for the current markets. We may again then go seek 16,800 or something like that. But it doesn't seem like that to me, that we want to go down. The market is, in a way, jiggling here, looking for the next uptick. So the two events that are coming up, which are important, besides the results that are trickling in, are the next Fed meet, which is ends on February 1st. So February 1st night is when we get the news what is the Fed doing with the interest rates, and of course we have the budget on Fed first morning as well. So February 1st will be a climactic day for the markets, and we will have a big swing post that day, either way. I think that remains to be seen what we do post that. One very interesting chart on crude oil is that while nobody is looking at crude oil right now, but over the last couple of months, crude oil, if you see the monthly chart, has made very long wicks on its monthly candles. And usually, multiple long wicks on monthly candles. And if it does break out above 90 here, then I think we've done this correction and then we're going much higher. So this is something that we need to watch out for. Because it has come off from 120 to 85 does not mean that the oil rally is over. It has been a nice 6, 7, 8 months of correction, but it may just about be starting again, having taken support somewhere around $85. So this is something that one needs to be looking out for. In terms of the sectoral market today, markets were in fine fettle except for PSU banks, which lost 1.8%. Uh, FMCG led the rally with Hindustan Levers at plus 1.2%. Real estate stocks also doing well, energy stocks doing well, infra stocks doing well. So reasonably good all-round performance, except pharma and PSU banks, which were sulking in today's market. Nifty 50 up 0.9%. So a lot of heavyweight movement today. We are yet to, I think, see the FI numbers for the day, but my sense is that FI selling is kind of drawing lower, and it is they're withdrawing from the sales. I think in the next few weeks we should start to see, I think, positive numbers from FI. That is just a guess that I have. CNX 200, CNX 500 also up by almost 0.5%. Nifty Next 50 mid and small cap index and small cap index, however, staying flat or negative. and also reflected in many of the weekend investing small cases, which are mid cap and small cap oriented. NNF10 doing the best here at plus 0.59%, but not any remarkable move in any of these. Today's heat map, you can see PSU banking led down by State Bank of India minus 1.67%, although private banks were up. HDFC Bank up 1.5%, Kotak Bank was up 0.72%. Other stocks that are heavyweights which were up, Hindustan Levers 2.7% up, L&T 3.5% up. So L&T usually moves a lot before the budget. That seems to be happening. Reliance was up 1.4%. A lot of buy calls on Reliance. HCL Tech after its numbers up 1.5%. TCS and Infosys also up, along with Tech Mahindra. Maruti up 1%. So I think reasonably good broad-based rally to say that we are trying to protect that 18,000 mark on the Nifty. Coming to the topic, what to expect from the budget. So a very nice tweet I saw from Fundamental Gems. So full credit to Fundamental Gems and Mint, who published this infographic about the history of capital gains. So I thought it will be very nice for everybody to know about this, those who have not seen it. So the history of capital gains from 1947 is like this: that a very nice idea that the exemption limit of the capital gains was based on the per capita income. So per capita income in 1947 was 265 rupees, and 57 times 265 was 15,000 rupees. So up to 57 times per capita income, no capital gains. That was the formula that was put in by TT Krishnamachari in 1956, made permanent in 1956, introduced in 46-47. Uh, 15,000 to 50,000 was 6%, 50,000 to 2 lakhs was 12%, more than 10 lakhs was 31%. Now, these numbers may sound nominal, but in 1947, they were huge. I mean, if we see in the comparison, then multiple of 57 exemption limit should have been at 1.5 lakhs of per capita income. Till 85.5 lakhs, there should be no capital gains if we were to extend this formula till today. But now, of course, we have LTCG up to 1 lakh only, which is exempt. In 70 years back, we had only about maybe about 10% tax of, I mean, it's not even comparable actually. LTCG after 1 lakh is 10%, STCG is 15%. Per capita at that point was 265, now it is 1.5 lakh. So I think somewhere, the forefathers had a very nice view about how to tax capital gains, which has been lost along the way. Uh, I hope the finance minister would have seen this article in the Mint and taken some motivation from here. I mean, just imagine 85.5 lakhs, no capital gains. So, from going from the 50s into the 90s, so 1992, Manmohan Singh introduced the indexation benefits for tax capital gains. So, special tax rate of 20% for LTCG. STCG short term remained at slab rate, dividends remained in the hands of the shareholders. 97, Mr. P. Chidambaram came. He abolished the dividend tax in the hands of shareholders and instead added a DDT, the dividend distribution tax, in the hands of the companies. LTCG he maintained 20% with indexation. Slab rate was maintained for STCG. Dividends exempted for shareholders. So this was the change that happened when Mr. P. Chidambaram came in. Then the government changed. 99 again, Mr. Yashwant Sinha came and he introduced LTCG with indexation at 20% or 10% without indexation. So another new slab was created, 10% without indexation, and everything else remaining the same. And in the next budget in 2002, he introduced taxation in the hands of the shareholders again. Uh, Everything else remaining the same. So you see, there's a huge flip flop that is happening on the taxation of dividends from one regime to the other. And then in 2003, Jashwant Sinha was the finance minister, and he moved back to tax-free status for dividends. Everything else remaining the same. In 2004, Mr. P. Chidambaram came and he exempted long-term capital gains to zero. Short-term capital gains from slab rate was made 10%, and securities transaction tax was introduced. Uh, and short-term capital gains was 10%. I mean, and dividends exempted for shareholders only in the hands of the dividend distribution tax in the company. So this was a huge bonanza that Mr. P. Chidambaram unleashed in 2004, where long-term capital gain for the first time ever became exempted. And the whole idea of the exemption was that we will collect enough securities transaction tax to make good for the loss of revenue from long-term capital gains. In 2008, Mr. P. Chidambaram remained with the exempted LTCG but increased the STCG by 5% to 15%, uh, and dividend remained exempt for shareholders. In 2016, in Mr. Jaitley's regime, LTCG remained exempt, STCG remained at 15%, but he created a 10% tax on dividends more than 10 lakhs per annum, and everything else on the capital gains remained pretty much the same till 2018, where another slab was put in that above 1 lakhs it will be 10% and up to 1 lakh LTCG will be 0. STCG remained the same. Dividend remained 10% for dividends more than 10 lakhs per annum. 2020, Ms. Sitaraman, dividends were taxed at the hands of the shareholders at slab rate. So this 10% also was gone, and dividends to be taxed at shareholders at slab rate. STCG and LTCG remained the same. So there, I mean, if you see the last 30 years, it has been a huge flip flop of various tax slabs, various sub slabs. I mean, I think each finance minister comes with their own set of thought processes and the team that backs him or her, and they will do their fine tuning. So this is not really very good for the long term stability of the tax regime. I mean, what is the logic of introducing STT and removing at long-term capital gains if STT proceeds were to, replace LTCG? And once we had that logic in place that STT is replacing the LTCG, then bringing back the LTCG with STT remaining in place actually should be a contestable idea. So, from all perspectives, I think all these finance ministers have been extremely confused about the long term glide pathway for the taxation of Indian capital markets. And nobody has been able to come out with a plan where at least for 10, 15, 20, 25 years you can allow the same regime to continue, so that investors know ahead what is the tax brackets they are getting into. And I'm not even talking about the flip flops that are there within other asset classes, whether gold or real estate and all those bonds, etc. This is purely equity that I'm talking about. So this time there are murmurs that some simplification of tax regime may happen. Maybe they are going to increase the rates because there is pressure on the fiscal deficit, and to expect that anything lenient will come through in the budget, I think is not my expectation, at least. If they leave things as it is, I think that will be the biggest positive surprise going into this budget. But I am a bit concerned that there will be some tinkering to raise more revenue from this budget, and we may see some hike in LTCG, maybe with a wider time horizon, not 12 months, but maybe 24 months, and bringing other asset classes from 36 months to 24 months. So I think the babus in the finance ministry are planning probably some tinkering like this. But I would think that all these finance ministers haven't really done a great job in terms of having a smooth and simplified regime going forward for the country's investors. So I think with the current disposition being there for many years now, I think it is high time that we have a clear roadmap for the next 5-10 years, that this is going to be the tax regime, and let it not be overlapping. So, if LTCG was removed in favor of STT, then either STT goes away and LTCG is increased, or let STT remain and not introduce LTCG in any other larger fashion. So, with that hope and expectation, I want to come to an end to this video. Please do write in the comments what are your expectations. Although at the end of it, this is mere speculation and nobody really knows what's going to happen. But these are what the murmurs are, the rumors are, the discussions in various circles that are going on for in regard to capital gains. But at the end of it all, if India as a market is doing well in the next 2, 3, 4, 5, 10 years, then I think a bit of tinkering here or there will not make a whole lot of a difference. But I certainly would like the finance minister now and the ones in future to not have this mentality of coming to the budget exercise every year and trying to turn the screwdriver. So with those words, thank you so much for watching, and I hope you have a great day. And please do keep sharing these videos, and I'll see you in another one. Bye.